Hello and welcome back to the ROI podcast, the Return on Investment podcast, where one of my favorite value degens is back. I've got my value cardigan on. We're going to get all up in the grill of value today, ladies and gentlemen. It's return guest, Mr. Stephen Farrington from Unemployed Value Degen. Make sure you check out his amazing Substack. The link will be in the description. Disclaimer, of course, nothing that we say here is advice, but we're also going to try and be useful. We're going to just record a chat between two lads, bouncing ideas back and forth across the ocean. So without further ado, Stephen, how are you today? What's happening?
Oh, I'm fantastic today. I mean, it's July in Tampa, so it's a little steamy out there, and I finally got around to mowing the lawn this morning. It's every day it rains, and then you don't want to mow the lawn because the grass is wet, and then though the grass is longer, then it rains the next day, and then it's wet and it's longer, and then it rains the next day and it's even longer. So I finally made it out there on the 4th of July weekend to cut the grass before I get a notice from the city council.
Very good, very productive, sir. Speaking of productive, we've got a couple of your ideas here today that I'd like to discuss straight from the horse's mouth, so to speak. I'd like to begin with PROFRAC Holding Corp. The ticker is ACDC. I don't know anything about this company, so why don't you give me the investment case, the thesis, and then we'll discuss some of the more nitty-gritty details on the investment idea that is PROFRAC Holding Corp.
Yeah, this is one of the first companies I wrote about, and it was before I had very many subscribers, so it didn't get a lot of attention. But I was trying to think about which of the companies I'm following that have the most imminent catalysts. I think this one might be, even this earnings call, the next, it might be worth digging into pretty fast. The company, you guys are into oil services in the form of offshore, but this is on land oil services. So they provide fleets of pump trucks for the different shale basins for fracking. Now they have, I think, 45 fleets of pump trucks. The company itself, what I really like about the ownership structure, I'm always trying to find businesses run by capitalists and not run by professional management that just want to collect a salary and drive the business into the ground. The company's managed, the CEO and the president, the Wilkes family, they're cousins, and their fathers or brothers who had previously done a oil and gas roll-up that they then sold for $3 billion. So this is now the second generation that it was the same setup with Carvana, where Ernie Garcia II had built a car empire, and then his son, Ernie Garcia III, he doesn't have a car empire, but he has all the youth and enthusiasm, but his father has all the knowledge and experience. You get the knowledge, the experience, the relationships of a successful capitalist, and you have all the enthusiasm and energy of the next generation. So for me, that's a really nice leadership structure. And the brothers, the Wilkes brothers, they're the majority owners of the company. So the threat of dilution is they don't want to dilute themselves. That's one of the things I look for, because I'm always looking at companies. Can they go bankrupt? Are they going to dilute shareholders? And are they going to go obsolete? If I can avoid those three things, then usually I can just wait until the business improves. So if there's no threat of bankruptcy, no dilution, and the technology is not going obsolete, then, even if I'm only half right, I can kind of punt at it. So they're currently doing a roll-up, and it's a debt-fueled roll-up. So they're borrowing money, buying other companies, and becoming vertically integrated. In all the cyclical industries, which the oil field services, the shale basin, is going to be a cyclical industry, but you're always looking for who's the low-cost provider, because when companies get shaken out, it's the low-cost providers that are going to last. So the vertical integration from their roll-up makes them, I believe, pretty good on the low-cost provider scale. And then as far as, what sort of longevity the business has, now that it feels like when interest rates went from 0 to 5, the environmentalist movement kind of took a major chill pill. It seems like that some of the craziness was only possible at 0% interest rates. And natural gas has reduced carbon dioxide emissions more than all solar panels and windmills ever built. So the fracking in the United States to make more natural gas should be, it's important for electricity generation, to retire coal power plants. That it's the sort of thing that it's not a sunset industry. There's people that say we're getting off coal, but nobody's saying we're getting off natural gas. They call it, the stepping stone energy source until we get to where we want to be. So it's a growth industry. The ticker symbol is ACDC because the trend now is to use electric pump trucks. So one of the problems with shale drilling is you get oil and you get natural gas. And if you don't have the pipelines and the storage tanks to get the natural gas where it's going, well, they would flare the natural gas. They would just burn it at the site. But now environmentalists don't like that. So there's pressure to outlaw flaring. Also, from a cost perspective, running all this machinery on diesel is expensive. So the new strategy is you take the natural gas that's coming out of your wells anyway, that you would either be flaring or selling, sometimes for a negative amount by the time you take in the cost to go through the pipeline and the midstream and you pay the transfer of it. And just use that on the site to generate electricity to run electric pump trucks. You're going to be burning your own natural gas on site. That's what that's why PROFRAC symbol is ACDC. They're focusing on electric pump trucks. And that's kind of the direction the whole industry is going in. They're not the only ones. But they are, with all their roll-ups, they're pretty good size. The stock price got depressed pretty hard because the management made a mistake. Now, they owned up to their mistake. They zigged when they should have zagged. Remember how one of the differences between Transocean and Valaris is that Valaris is just filling all the white space, leasing out all the rigs, no matter what the price is. Transocean's trying to hold the line on price, and they are, moving the price higher pretty well. So Transocean seems to have enough market power to do that. ProFrac thought they had enough market power, and they didn't. So they went from having 40 active fleets to, I think, being down in the low 20s because they held the line on price. So if you look at their income, it looks pretty bad. But last quarter, management came out, the Wilks cousins came out, they did the mea culpa. They said, look, that was a strategic mistake. We're correcting it. We're going to focus on having all the fleets deployed because we need to spread our fixed costs out across all the fleets. And as of now, they stopped giving guidance on the exact number of fleets deployed, but last earnings call, it was in the low 30s.
Okay.
This next quarter or the quarter after, they'll be in the high 30s or maybe the low 40s for number of fleets of pump trucks deployed. And you guys, some of your viewers might go to the oilprice.com and look at the number of the rig count in the United States. Now it keeps on dropping and dropping. Well, even with the declining rig count, with prices not at a premium until we get into the next boom phase, maybe when all the LNG terminals come online and we're exporting natural gas will be in the next boom phase. Their prediction is with their vertical integration in a boom phase at high prices, each fleet could generate $50 million of EBITDA in a year. And that's across 40 fleets for about a $1.2 billion market cap company. At current depressed prices, they think they can probably make about 20 million in EBITDA a year per fleet. So when they get 40 fleets deployed at about 20 million EBITDA a year, they'll be on an 800 million EBITDA a year run rate, and they'll probably be there this quarter or next.
So their plans is really quite imminent on as you said, market cap. I'm looking right now, 1.2 billion, enterprise value 2.4 billion. Okay, interesting. Yeah,
and their goal for those funds, because the Wilks family doesn't want to dilute themselves, it was a debt-fueled roll-up. They want to take that 800 million EBITDA over the 12 months starting maybe this quarter, maybe next, and they plan on paying down about $500 million of debt. So that's sort of the most immediate plans, is just to get all the fleets deployed, spread your fixed costs out across all the fleets, make about $20 million in EBITDA a year for each deployed fleet, about $800 million for the next 12 months once they hit that milestone, pay off a giant chunk of debt. And I have heard rumors from people that work in the oil and gas industry in Midland, Texas, that they're not done shopping. They're looking to go out and acquire more. Now, the reason why, because I'm a small cap value degen, the reason why I'm interested in size is because for the last 20 years, small has underperformed large. And a lot of us are waiting for, when are small caps going to have their day? When are we going to, be able to have some nice schadenfreude where we're making money and NVIDIA is crashing and big cap tech is losing and we're winning? When is that day going to come? Because we've been waiting for it for years.
Yeah.
And one other potential strategy would be, well, the appeal of a roll-up is as this company gets larger, you could eventually start getting ETF index inclusions. You could eventually start fetching a higher multiple because of size. So if small doesn't have its day in the sun, or what's nice about a roll-up is you could not just get, there's kind of three ways to get your stock price to go up. One is organic growth. The company grows, it has more earnings. And the other one is, you buy something cheap and it re-rates to fair value. And then beyond that, it's multiple expansion, that the multiple actually goes higher. And one of the ways to get the multiple higher is to become large enough for ETF inclusion. So I like the leadership structure. I like the fit. It's a very necessary thing. The US is hooked on shale oil and gas, and we want to become, the world's leading exporter, building all these export terminals. So it seems like there's a lot of good years ahead of oil field services, especially in the fracking space. And the chance that they could actually, be a pretty good size, maybe get a multiple re-rating. And there's, because of the management's mistake, trying to hold the line on price and zigging when they should have zagged, the stock price is really depressed right now. I think I bought in closer to $10 a share. Now it's down to $7 a share. So that just returning to fair value and then start to make money hand over fist, pay down debt, probably, increase, roll up even more. There's another aspect to it. I don't know how much your viewers want to get too much into the nitty gritty, but part of the roll up process, they acquired a lot of sand mines. So fracking, you have to inject a very specific kind of sand, keep the cracks open. They have 7 sand mines, I think one to serve each of the major shale basins. And it creates a good co, bad co structure because the sand mine business is very stable, would have a much higher multiple than the oil field services business. And management's aware of this, and they've prepared the accounting to do an eventual spinoff or a sale. So their subsidiary, Alpine Silica, there will be another imminent catalyst. They might be waiting for the valuation in the market generally for small caps to be higher. But the spinoff or the maybe sale of Alpine, I think it's probably desired to be a spinoff more than a sale of Alpine Silica is another catalyst. You have the catalyst from just spreading the costs out across 40 fleets. You have the catalyst from when all the LNG export terminals come online in 2025. Then you have the catalyst from the good co, bad co spinoff. I think it's a great story. I'm pretty fond of it. And then because it was one of the earlier articles I wrote on my Substack, just not a lot of people saw it.
No, I think you've uncovered a little bit of gold there, a little bit of black gold. So that's the thesis. Let's dive in a little bit around the numeric aspects. You mentioned a spin-off. What do you think they could get for the Silico if they were to spin it off? The ballpark figure.
Well, I know the multiples are typically much higher because the business is so much more stable. It all depends on how the market likes it at the time, and I've been so focused on the primary business, just the fleet of the pump trucks. I haven't gone ahead and put a multiple on that. I think it was somewhere in the $200 to $300 million range, but I could be mistaken about that. So it's not a large part of their business, but it was a part of the roll-up that created the good co, bad co situation where it probably does need to be split.
Okay, so it's a potential bonus, a call option on whatever happens with that particular spin-off. You mentioned that your primary point today was around the insider ownership. So I'm looking at the percentage of shares outstanding. So the Wilkes Family Trust owns 37.25% of the shares outstanding, according to these numbers. And then you've got Matt Wilkes, Jonathan Wilkes. They each own over $10 million worth each. So certainly seems to be a key consideration, ticking the box there. Are you valuing this thing mainly on a cash flow perspective? So you're saying you're getting to this point where 20 million per rig equals X amount of EBITDA, you slap a multiple on that? Or are you looking at the value, the asset value of the trucks? Because as I'm looking at it, I think that it's trading at a slight discount to its asset value. In addition to which, we've got this catalyst for a runway where over the next 12 months, it might be at current prices trading at 30 to 40% free cash flow yield. Does that seem reasonable or unreasonable?
That's, I mean, well, if you're doing operating cash flow, you'd get something closer to 800 million. But if they pay down 500 million of debt with it, your free cash flow would be maybe down to 300 million for once they're back up to 40 fleets deployed. But I think the reason to buy this thing, I wouldn't sell this. And a company, multiples are so low in oil and gas generally because it's so hated that the cash flow yield is so high that I really wouldn't sell it unless we got to that peak of the cycle where oil field services were tight and they really hit their peak earning capacity of that 50 million EBITDA per fleet. And if they had all 45, and also they have a subsidiary that can build new fleets. So they have a manufacturing arm that can build out the pump trucks themselves. That's part of one of the companies they bought in the roll-up. So if you have 45 fleets deployed and each fleet is bringing in 50 million EBITDA a year, that would be 1 year's earnings, which is, more than twice the current market cap of the company. Yeah. I mean, that's just an absurd. So I wouldn't put a exit price target on this thing until, however many years it takes to get to the peak of the next oil field services, shale, fracking boom. And that'll probably be after the export terminals come online, after we start sending some natural gas overseas, which is within a year or two. Some of that's going to start happening and prices could go up.
Mid-25, from what I read, billions of cubic feet worth of capacity added is all supposed to be coming online by then.
Yeah. So that's,
wow.
But I don't know how many years it'll take to get to the peak of the next cycle. But in the meantime, it's a business run by prudent management that have every incentive to, if they diluted, it would only be accretive. I'm not saying they'll never dilute you. What I'm saying is, if they did do a stock-based acquisition, it would have to be a really good one. Because who's going to, dilute their father and their uncle just to, try and increase your CEO salary? It doesn't make any sense. Yeah. That would make a very uncomfortable Thanksgiving and Christmas dinner.
Yeah, I really like the degree of insider ownership, especially when they're doing the roll-up. Now, the other thing you've got to watch with roll-ups, which have a very special place in my heart. That was my first venture back when interest rates were like 4%. You could get a commercial loan and you could buy private businesses with 30% free cash flow yields. I mean, they were really the days. The debt actually doesn't seem unreasonable as I'm looking at it right now. I mean, I'm looking at the balance sheet and I'm seeing, look, net debt to EBITDA minus capex less than 3. Doesn't seem to be particularly unreasonable. Their liquidity profile, their debt maturities are all checking out from what you've seen.
Yeah, it's not much imminent, not much too outrageous interest rates. Every once in a while, they'll the stock price will get a ding because I think they've done some financing where rather than going to the debt markets and taking out something at really high interest rates, they'll sell some preferred stock within the family. And you always have to watch out that if they're, because it's a controlled company, they could be cutting the cake with more icing for themselves. That's always possible. But it really looks to me more like a situation where they just don't want to be faced with market interest rates in a world where the banks are, loathing lending to the oil and gas space. They'd rather just, keep it in the family and self-finance that. But yeah, the debt doesn't seem too unreasonable, especially where, right now they're not exactly at trough earnings, but they're pretty close to trough earnings. That when they really held the line on price and thought that they had enough market power to do that, and then they were wrong, and their number of fleets outstanding collapsed. I think right now the numbers you see for EBITDA is pretty much at the low. It's if management's doing a good job, and my best take from earnings calls is management's doing a pretty good job. Everybody makes mistakes, but I do like the management team. I think the comparing debt to current EBITDA is, still looks not so bad. Comparing it to $800 million EBITDA run rate when they have 40 fleets at 20 million each, not including the Alpine Silica, which is, adding to the EBITDA also. It's like I'm not the first person to say this, but people are comparing oil and gas to the new tobacco, that nobody wants to own it. Everybody hates it. So the earnings potential for these things are outrageous. I don't know at what point they would ever return capital to shareholders, because the downside with a roll up is all the money they make is going to go to buy more stuff. But if they do good purchases, and it looks like they've done fantastic purchases, and they increase the size of the business to get to some ETF inclusion and get higher multiples, I mean, at some point you run out of things to buy and they'll have to return capital to shareholders someday. But what the previous generation did is you get the company to the size you want to get it to, and then you sell it. So that's what the father and the uncle of the CEO did. They sold, I forget the name of the company they created, but they sold their ownership stake for $3 billion. That was their sort of, culmination of their careers.
Okay. Very good, successful track record. You mentioned a few things. You mentioned competitors. I'm looking at relative valuation across their peers, and I know they probably all do a little bit of different things, and there's a large variation between the sizes of companies in this space. But they are by far the cheapest on a market cap to free cash flow valuation at the moment.
Yeah.
The median is around 9x, but that includes some of the bigger not mega caps, but large caps in the space. 2.6 times market cap to free cash flow seems just insane to me. They're paying about 3 times the current EBITDA. The other option is, you mentioned the market power. Who else plays in this space that might be in the offshore? We know who the players are, and we know where the status of the utilization is for rigs and all that sort of thing.
Well, the
how do we get
onshore.
it onshore?
Go ahead.
What happens?
Yeah,
What
so
happens with
the onshore oil services, there's a lot of private players, so it's a lot harder to get the information. Where offshore, almost everybody big is public, and you get all the information. On the onshore, there's a lot of private players in the oil and gas space, and so there's a little bit of a black box that you can't look into for those companies. They're relatively big. I mean, if you only have 600 active rigs out there in the United States, and they've got, I think they have low 30s right now deployed, and trying to get their way back up to 40 deployed. That's a not insignificant chunk of that market. But again, they really overestimated their market power when they tried to hold the line on price, because they didn't. And I find this, my background is in economics, and the thing that leftist economists love to talk about is market power, and you almost never see it. There's all this theoretical argument about, oh, well, they could just raise prices and they could keep all this, producer surplus for themselves. But whenever somebody actually tries to do it in the real world, it usually doesn't work out that well for them. So anyway, for my colleagues in academia that are more, left wing on the economic side of things, another example of market power is not all it's cracked up to be.
Yeah, indeed. When you think, okay, current rig count as I'm looking is 585 rigs, and yes, that's oil and gas and what have you. 45 total fleet doesn't seem to be enough to really move the needle in that aspect. With our, I guess, last point coming into the catalyst for a multiple re-rate might be, we're thinking an ETF inclusion. Those days seem getting closer, but still quite a long way for ETFs to consider oil and gas companies. At what kind of market cap would that be necessary, or what market cap would be necessary to trigger that ETF inclusion?
Well, so I know a couple of the companies that I was in the past, when they get included into the S&P 600 small cap index, it's had a pretty good effect. It's not an immediate bump up in the price, but in the months that follow, it grinds higher pretty well. And that happens, I think, with Jackson Financial. That was something in the 5 billion market cap range. But since the world hates oil and gas, maybe you would have to be a bit bigger than that. But an inclusion of something like the S&P 600 would be a huge leg up. I don't know what the Wilks family roll-up plans are. I don't know if they want to, spend 80 years turning it into the next Hess or something like that. But I'd figure that they would probably sell the company at some point, somewhere around that size. Well, maybe bigger, who knows? But management will just have to discover, what the limits of what they can manage is.
Yeah, well, if we're thinking with the rigs deployed and with a higher rate, getting somewhere around that maybe 2 to 3 billion in EBITDA, 5x EV to EBITDA on that. So you're looking at 10 to 15 billion. That doesn't seem unreasonable.
Yeah. I think it's a great setup. And I haven't spent a lot of time putting a price target on it because I'll be waiting for at some point we'll have tightness in the shale oil field services market because everybody's drill baby drill, maybe because Trump is president or something like that. Who knows? Or most likely it's the LNG export terminals coming online. Or maybe Europe has a cold winter. Who knows what's going to cause it? But at some point there's going to be another shale oil boom, and then the oil field services. It was a couple years ago. I know Josh Young at Bison Energy was talking about how tight things were in the market, and he was saying, things that the price never moved. Things like sand. There was a time you couldn't even get the sand because it was just everything was tight. So when that happens again, probably I would sell and look to get back in at a lower price again when they really have some absurd peak cyclical earnings.
Yeah. And potentially this company, as a point of difference, may attract more ESG type capital or be less hated by ESG because it's got electric in the name of its electric vehicle trucks, potentially.
You would hope so, but I'm not holding my breath on that one. In some of my Substack articles, I write about this a little bit about where the environmentalists are coming from, and it's almost like I know a lot of people on the left were kind of cheering the decline of Christianity, and I was always very suspicious about that because I don't think there's any people out there that don't have a religion. There's people that don't know what their religion is, but I think there's people without a religion. And I think the environmentalist movement, it's a lot more like a Mother Earth religion. And if you're in this Mother Earth religion, the Mother Goddess is supposed to take care of you. That's why wind and solar are so favored, because that's, the bounty of the Mother Goddess. And even though nuclear doesn't produce any carbon dioxide and it produces baseload power, it's evil because it's artificial, right? It's not from the Mother Goddess. Now, even minerals and mining that is so essential for windmills and solar panels, you would think that the environmentalists would not be trying to seize power and deny these companies permits, but they don't really need there to be more windmills and solar panels. What they need is for the Mother Goddess not to have her minerals extracted, because that's an aggressive act against in their religion. You can't defile the Mother Goddess. So I have very, very little hope that even if it is electric pump trucks, no matter how much carbon dioxide is reduced from natural gas, I don't think you'll get a huge ESG re-rating. That's just my kind of pessimistic take on where the environmentalists are coming from.
Potentially, maybe you could explain to the environmentalists that Mama Earth does provide hydrocarbons and uranium in the Earth's soil. I mean, who knows? Anyway, enough said. Let's move on to